sell-off in US stocks deepens into Friday as mounting fears of a hawkish pivot by the Fed fuels a retreat from risky assets. The pound and gilts pair losses after sources say improved economic forecasts were behind government moves to scrap plans for income tax rises. And Richemont shares jumped the most since March as shoppers from the US to China snapped up the luxury goods' expensive Cartier and Van Cleef jewellery. Well, welcome to the programme. For a moment there, I thought we needed to start saying Rachel Reeves always chickens out. Gilts were selling off the most since the UK Chancellor cried in Parliament. The pound was tanking against the dollar. But now we have an explanation for an expected U-turn on income taxes. Better forecasts. And as you can see, those moves reversing now. More broadly, though, stocks on the back foot this morning as doubts about AI valuations rear their heads again. And as that December Fed cut looks rocky, Nasdaq futures pointing south and oil surging on a Russian port attack and tougher US sanctions. Let's dive into what's happening across the European continent. It is red across the map. Domestic UK stocks not liking the ideas of a Reeves U-turn, so the FTSE 250 paring some of the earlier losses. Switzerland, though, performing the least badly thanks to those Richemont earnings. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Well, it's been a turbulent end to the week for the pound after Bloomberg learned that the UK Chancellor, Rachel Reeves, was considering dropping plans to raise income tax and a slew of other levies at the upcoming budget. Reports in the last few minutes, though, say that that decision may have been driven by improved economic forecasts. Let's clear all this up. We can bring in Bloomberg's James Woolcock for the latest. James, we had Reeves saying in her speech last week, or at least hinting, that she was going to break the manifesto. Then it seemed she wasn't going to raise income tax in the budget. And now we've got these latest developments on forecasts. What's going on? What's the thinking behind all of this?
Well, to understand the thinking, there are three constituencies you need to bear in mind: the public, Labour MPs and the markets. Reeves is trying to keep all of them happy. And so that was why 2 weeks ago she started saying tough decisions need to come. And that led to lots of speculation, even from her own backbenchers, that a manifesto break, a break of her election pledges was coming, and that would be income tax. Now, the markets and business took that very well. Her own backbenchers did not. And what can't be escaped is this has been an awful week for the government. You have had rumours of plotting. We are now in a doctor's strike as of today. And the Prime Minister has seen a low polls, making him one of the most unapproved of prime ministers in British political history. That led to this bombshell report we had last night that income tax was being dropped. Markets did not like that an hour ago, and within an hour, government sources have spoken to Bloomberg and saying the forecasts have improved, and they now are expecting to have between 15 to 20 billion pounds of headroom at the end of the budget. This is a balancing act as the government goes between those three constituencies I mentioned, trying to keep all of them happy. The question is, can it?
And how is she likely to balance the books here? If it's what tax levers or spending cuts are available to the Chancellor at this point, pleasing as many of those constituencies as possible?
We can kind of see the markers at this point. Imagine a tank, if you will. We started with £10 billion headroom. We know the welfare backfiring over the year loses about £5 billion. We expected the OBR downgrade to lose somewhere within 20 to 30 billion based on our reporting. And now we're told that without income tax, she's still going to end up somewhere between 15 to 20 billion. That's according to our latest reporting. It all might change by the budget day. That leaves a roughly, give or take, a kind of 30 billion hole to fill. That we are hearing that salary sacrifices and a cap on those, which has been reported, so that's how much employees can put in tax-free into their pensions per year, could be a good way of getting to that. There are others on the mix. You could imagine, say, an EV tax has been floated, a tax on limited liability partnerships, gambling and betting companies. At one point, a bank tax had been effectively ruled out. But it's worth saying, at this point, with the Treasury looking to raise money, a lot of these smaller, sort of low-digit billion raising options are back on the table, and the focus for us and the team here is reporting what might be in the budget in 2 weeks' time.
OK, Bloomberg's James Wilcock, we thank you so much for breaking that down for us. We're looking at gilt yields still up 6 basis points on the 10-year. They were up about 13 basis points at the start of the session, so pairing some of those gains now. But let's get some more analysis. We have Mohit Kumar, Chief Europe Economist and Strategist over at Jefferies. Really good to have you. Oh, what an exciting moment, Mohit. I mean, I started the day wondering whether we should start saying Rachel always chickens out, because she couldn't get the spending cuts past the left of her party. Then it seemed like she couldn't get a big income tax past the left of her party, tax rise. Now it seems like the forecasts are going to give her cover for a fudge. Is this enough for the bond vigilantes? Yield's still up on the 10-year.
I don't think so, unfortunately. So I fully agree with what James was saying, that you're trying to balance the voters, the Labour MPs and the market. And it's very easy to say that we have better forecast and because of which we have more headroom. But let's look at numbers. If you remember last time, OBR had 1.7 to 1.9% UK growth for 2027 to 29. It will be reduced downwards, we know it. But we could come with something like 1.4, 1.5. Our expectation is close to 1. So I fear that the forecast that we would have in the budget, which gives an optically good budget, are just too optimistic. So
you've got a global focus. Put this into context for us. How much worse a position is the UK in to, the likes of the US and France?
Versus US, absolutely in a worse position, simply because dollar still remains a reserve currency. And yes, there are lots of talks of people moving out of the dollar. Problem is there is nothing but the dollar. France, I would say UK and France are in similar situation. Potentially UK is in a slightly worse situation compared to France, because a lot of investors look at France, they look at spreads versus bonds, they look at spreads versus Italy. There is a limit to which France can sell off. UK, unfortunately, doesn't have that natural investor bias. So the way we are looking at, maybe optically we get a good budget. I think yields will probably not rise till the budget. But the moment we get the budget, all the analysts do their analysis, they figure out actually it's not good. We should see a steepening of the curve again.
Do you know what's interesting, Mohit? I'm just looking at traders' bets for a Bank of England rate cut in December. It's still 19 basis points of cuts priced for December, so that's not really changed here.
No.
Are you seeing one?
We are in the December rate cut camp. We actually think, like, going back to the growth forecast numbers, if it is going to be close to 1 for the next 3 years rather than 1.4, we think Bank of England needs to deliver more than what's priced in, even now. So the latest U-turn, or if we call it a U-turn, is not about Bank of England. Growth is about Bank of England. So we are definitely in the camp of a December cut. Actually, we go a step further and believe that Bank of England takes rates to 3% by end of next year, which is more than what's currently forecast. So we are long gilts at the front end. Long end is a different story. That's about the fiscal part. So that's why it's a steepening of the curve.
But what could Reeves do to derail that?
Well, have a credible budget, which is numbers which are not just based on productivity gains or based on optimistic growth forecast, but numbers which make sense from a tax cuts and spending cuts perspective. The problem is, and exactly what James was saying earlier, you need to make the voters happy. You need to make the Labour MPs happy. It's a very delicate balancing act.
All right, Mohit, I hope you'll stay with me because there's loads more I want to ask you. That's Mohit Kumar, Chief Europe Economist and Strategist over at Jefferies. But I also need to talk to you about the US because there are growing doubts that the Fed's going to cut rates next month, with Governor Neel Kashkari saying that he's still undecided. Kashkari didn't support the last rate cut, remember, but he says it could go either way at the next meeting.
We have inflation that's still too high, running at about 3%. Some sectors of the U.S. economy look like they're doing great. Some sectors of the labor market look like they're under pressure. How do we make sense of these mixed signals?
Let's bring in Bloomberg's managing editor for US economy and government, Mario Parker, for more. Mario, so good to have you with us. We've heard from Neel Kashkari, we've heard from Austin Goolsbee, we're going to hear from Jeff Schmidt, we'll hear from Beth Hammock, and we've got Laurie Logan on the docket for later today. All of them have been weighing against a December rate cut. Where are the doves?
No, I mean, and then you got Mary Daly now signaling some type of wavering as well. You've got Susan Collins doing the same, speaking about a high bar also. And some of this was telegraphed by Jay Powell during his more recent remarks, where he hinted at some of the debates that were taking place within the Federal Reserve Board. I mean, this is night and day from where we were a few months ago, but it speaks to this difficult position that the Fed finds itself in, as it has this 2% target that continues to be elusive, but then there's really hard to read data in terms of the economic health of the U.S. right now.
But of course, what's going on with the U.S. data is crucial. The lack of it's been clouding the outlook. Do we know yet what we're going to get?
And to that point, the Fed's job just got that much harder by this government shutdown, right? We know that we'll get September data pretty quickly, but that's so backward looking. The White House has signaled, that the administration has signaled that some of the key October data, CPI, BLS data as well, we may not even get some of that data. We've been, obviously, and our clients have as well, been very reliant on some of the private data, and even that looks shaky. But the Fed doesn't have some of the tools that it's used to having with the government.
All right, Bloomberg's managing editor for US economy and government, Mario Parker. Such a treat to have you with us in London. I want to get your take on this, Mohit. Mohit Kumar still with us, Chief Europe economist and strategist at Jefferies. I think you think that they are going to cut in December. So really, if they don't, will they be behind the curve?
I would say December is looking more like a 50-50.
Right.
And to your point earlier, Lizzie, and to what Mario was saying, it's the lack of data. They don't have enough data to justify a rate cut.
Does the lack of data back the hawks, basically?
I would say yes, because inflation is still high. If the Fed doesn't have data, the best thing to do is do nothing, wait for more data. That is the default action for the Fed. And a lot of people within the FOMC, and we heard Kashkari, we had Musalem, Hammock, all arguing for a bit of caution. Caution, to me, interprets as we need to see more data, particularly on the employment side weakening. If you don't have data, might as well wait another meeting.
Somewhat ironic for those in the White House calling for rate cuts. But look, what sort of data, similar question with the BOE, do you think would stop the Fed cutting rates in December?
Unfortunately, we rely on one key data point, and only one key data point, which is the payroll that comes on 5th of December. And that's just before the Fed meeting. So let's say, as an assumption, we get payrolls which are 70, 80K instead of a zero or a minus number.
Is that what you see?
Well, it's too early to make expectations. We need to see more data to firm up our numbers. But in that scenario, it is very difficult for the Fed to cut rates. So that, to me, is the biggest risk right now for markets. We have valuations a bit extended, positioning a bit long, and you get a bit of a hawkish Fed. We could be in for a bit of volatility.
OK, well, you are bullish equities, though, aren't you?
Absolutely.
I mean, the numbers this morning, when we look at the futures picture, NASDAQ futures down 0.4%. It feels like this question of when the AI bubble is going to burst is back on the table. When is it?
In my mind, if there is a bubble, and I'm not saying there is a bubble, I would say at least 2 years away. And 2 years is, in the financial market, like another lifetime. It's very difficult to trade what happens 2 years later. So I'm not in the bubble camp now. And that's why we remain bullish, with the acceptance that we could see some volatility over the coming weeks. But that, to me, is by the dip opportunity, is not start for sell-off.
OK, interesting. And then when you put the macro lens on that, how long is it going to take for all of this CapEx spending to translate into productivity gains, not just in the US, but here as well?
So the question to me is, when I look at CapEx and valuation, I mean, these are the two big concerns of AI. If you look at CapEx, the big difference versus a bubble territory or the dot-com territory is, in the dot-com era, CapEx was leveraged. Now, CapEx is coming from companies who are cash-rich. So the leverage concern is not there. So to me, what is important to watch is when we move to that leverage. And we have already seen, we had a few companies raising a lot of debt over the last few weeks. We are moving towards that leverage territory. But to me, that's a year, 2 years away. So that's why on your answer on when does CapEx translate into productivity concerns, it's all about leverage. Are we going to that stage? We are not there today. We could be there in 24 months' time.
But does it come with layoffs as well?
If the productivity gains are not there, absolutely. But then again, let's look at CapEx for next year. CapEx expectations for next year are even higher than this year. So if we get layoffs, potentially to me it's a 27 story, it's not a 26 story.
OK. Mohit, thank you so much. Mohit Kumar, Chief Europe Economist and Strategist at Jefferies. Really good to get your take both on the US and on the UK this morning. Coming up, the Greek Finance Minister. I'll be speaking to the Greek Finance Minister in just a moment. This after Greece has delivered one of Europe's most striking fiscal turnarounds. That's next. This is Bloomberg.
November 26th, Chancellor of the Exchequer Rachel Reeves delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
Excess regulation, excess taxation actually is a tax on the economy and growth. At some point, people don't invest. And so this is the balance we need to find. And Europe is getting further apart from the United States, not coming closer.
Santander Executive Chair Anna Botin there speaking to David Weston on Wall Street Week and what she thinks is limiting Europe's growth potential. Well, speaking of which, Greece has delivered one of Europe's most striking fiscal turnarounds, moving from a debt crisis that nearly forced it out of the currency bloc a decade ago to successfully becoming an outperformer. Set to submit its 2026 final budget and medium-term fiscal plan next week, it's now recognised as one of the peripheral economies reshaping investor expectations for the region, outpacing on growth and market performance. I'm delighted to welcome the Greek Minister of Economy and Finance, Kyriakos Pierrakakis. So good to have you. Thank you so much for stopping by, Minister.
Good morning. It's great to be here.
So, as I say, next week you're going to submit your 2026 final budget and Greece's medium-term fiscal plan. What are your forecasts when it comes to growth, the budget surplus, and your target for debt for the end of the period?
Well, as you very well know, as you mentioned before, we're a turnaround story and effectively a renewal story. And the projection, we already delivered the draft budget. We will be delivering the final budget next week. The projection is that we will be growing by 2.4% in 2026, much higher than the EU average. We will continue producing primary surpluses, 2.8%. And we have the most rapid de-escalation of debt. Remember, debt used to be 210% after COVID. Our plan, well, for next year, for 2026, is for 137.6%, but our plan is, before the decade is out, for the Greek debt to GDP ratio to be below 120%.
But on that debt, what's your borrowing plan for 2026? Are you going to front-load issuance?
In reality, we have a light borrowing plan, and we have a light borrowing plan because it's a good problem to have, in a sense. We produce primary surpluses right now. We're mostly focusing on the liquidity of the secondary market in terms of our debt management agency. But overall, the goal is early repayments. We already announced that we plan to repay the debt from the first bailout package of the first memorandum 10 years earlier, by 2031. We will even be exploring to front-load that if that's possible. But overall, our plan is to be quite aggressive in terms of debt reduction because this produces social costs. And we plan not to repeat the mistake of the previous generation, which was to pass the bill to the next one. We won't do that.
But you've got elections coming 12 to 18 months before, in 12 to 18 months. What are your priorities between now and then? Because usually politicians like to do a bit of spending in the run-up.
In reality, the way we're growing in a positive feedback loop where unemployment is limited. We have reached the low unemployment numbers of before the crisis. Growth is much higher than the EU average. So this allows us to have fiscal space while also having growth and fiscal surpluses at the same time. And in a recent program announced by the Prime Minister, we delivered the biggest tax cut in our history. We lowered income taxes across the board for all Greek citizens, primarily for families with kids, primarily for young Greeks. And overall, this is a very positive expansive policy to have, which the Greek economy allows us for.
OK. You've just come back from a Eurogroup meeting in Brussels. I've got to ask, who are you going to be backing to be the next Vice President of the ECB? Should it be a Greek name?
I cannot publicly comment on this, but what I can tell you right now is that we would like to have many Greek names overall in European institutions, because we believe that this would also symbolize the success of the Greek economy in the last years. We're a stability story, we're a growth story. This should be manifested by the participation of the people who made that story possible. OK,
so you want many Greek names on there, but there are 3 ECB posts up for grabs. You've got the chief economist, the president and a board member, but we've also got French elections coming, of course, in spring 2027. Would it make sense to announce all of those 3 in one go, in one package, at the start of 2027?
I would say that this is amongst the things that we will be discussing in the future. Those are future discussions to be had about how to staff the European institutions. We're mostly interested in policy, and this was one of the things that we discussed in the last couple of days at the Ecofin and Eurogroup meetings, where many decisions were made about the future of the European Union and the future of the European Monetary Union, customs reform, amongst other things, energy taxation, and on all of those things right now, we need to collectively make decisions fast. So because your question entails speed, speed should be of essence in the delivery of the policies primarily. And the number one policy that we need to deliver as Europeans is the Savings and Investment Union. We need more cross-border M&As, as the Draghi report mandates. And Greece is actually following the advice of William Faulkner to young writers. Show, don't tell. We're showing. We're pro cross-border M&As, and we're delivering.
Well, you'll be pleased to hear we're going to discuss that cross-border M&A with Jackie Ineke later in the programme. But I have to ask you about the policy on frozen Russian assets. Is it going to get over the line?
I can tell you that we fully support Ukraine. President Zelensky is going to be in Athens on Sunday. This support is manifested and has been manifested in the last years. On the specific policy, we're examining it. We believe that it needs to be legally sound. It needs to be further examined. We hope that it can manifest itself more at the European level rather than at the national level with regards to the mutualization of assets. But overall, I think that we will have a decision quite soon.
What's it going to take to get Belgium over the line?
Well, actually, this is, in my view, the KPI. Belgium needs to be over the line, and Belgium needs to be protected.
And if you can't get it, what's the fallback plan?
Well, currently we're discussing the other plan, so we're not yet there.
OK. Back to Greece, Minister. We're approaching the deadline for Euronext's public offer for Athex, the Athens Stock Exchange. It ends on Monday. Are you optimistic that the offering is going to succeed?
I am optimistic. We fully support the specific deal. I mentioned before, we're pro-cross-border M&As. I heard Chancellor Merz recently saying that we should ideally have one European stock exchange. Well, Greece needs access to this broader liquidity pool, and this is why we supported the Euronext deal. And we really hope that it can materialize. But it's not only Euronext. We had UniCredit increasing its equity share in Alpha Bank, in a Greek bank. Overall, we want to see more FDI, more investment happening in Greece. And Euronext's proposal for the Greek Stock Exchange is actually quite significant for us.
So participation is going to be high enough?
We're hoping that it will be positive. It's a private deal. It's a private business deal. On a political level, it has our full backing.
OK. Really, really great to have you with us here in London. That's the Greek Minister of Economy and Finance, Kyriakos Pierrakakis. Thank you so much for joining me round the desk. Well, just checking back in on these markets, because we've been seeing some incredible moves when it comes to the UK picture. We've got the FTSE 100 weak at 1.1% now. The broader stock 600 down 0.9%. So it's still lagging the benchmark index. But you're also seeing the Swiss index down only 0.3%. That's thanks to the earnings out of Richemont. We're going to dive into those in just a moment. Nasdaq futures down 0.4%. This, as we were discussing with Mohit, partly due to the questioning of the AI bubble, also because of the rockiness now around that December Fed rate cut. But if we look at the gilt picture here in the UK, we've got the 10-year gilt yield now up 7 basis points, still significantly more than the rest of the continent at the long end of the curve. For example, the 10-year Bund yield only up 2 basis points, but we have significantly paired the gilt yield gains since the start of the session. They opened up 13 basis points, and this comes down to what we've been hearing from the UK Chancellor, lines crossing just at the start of this programme, and we should recap those. Rachel Reeves still expected to deliver headroom of £15 to £20 billion, this according to sources. We have the latest UK fiscal forecast putting the gap at £20 billion, and we have UK forecasts leading Reeves to drop the income tax hike. Again, according to sources, but putting a reason on why the Chancellor would be making a U-turn from what she seemed to be hinting at in that speech on Tuesday, that she was going to break the Labour manifesto. The market did not like the idea of a U-turn on income tax earlier on. We seem to be reversing some of those moves, and we're looking at the pound against the dollar now still down, but only by 0.3% at $1.31. Coming up, Richemont sales climbing on better than expected demand from the US and China. We'll unpack those earnings next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. The pound and gilts paring losses after sources say that improved economic forecasts were behind government moves to scrap plans for income tax rises. The sell-off in US stocks deepens into Friday as mounting fears of a hawkish pivot by the Fed fuels a retreat from risky assets. And Richemont shares jumped the most since March as shoppers from the US to China snapped up the luxury group's expensive Cartier and Van Cleef jewellery. Well, diving into what's happening in UK assets, we have the 10-year gilt yield still up 7 basis points, but nowhere near as much as it was up at the start of the session. That was 13 basis points. The market not keen on the idea that Rachel Reeves was going to scrap an income tax rise that she rolled the pitch for last week, of course. Now we're told that better forecasts mean she can change her mind on all of this, and that actually we're still going to have headroom of 15 to 20 billion pounds. This according to sources, the latest UK fiscal forecast putting the gap at 20 billion pounds. And so we're also seeing the pound fluctuating here, but now weaker 0.3% at $1.31. It had gained significantly off the back of that U-turn, and then it's gone down again. So we're still in the red at the moment, and the FTSE 250 still the underperformer across the European continent when we look at indices, because domestic stocks not happy about all of this political back and forth coming out of Westminster. But you're looking at the Swiss market index, the outperformer this morning, as indeed is luxury as a sector across the stock 600, and this comes down to Richemont. Sales climbing on better than expected demand in both the Americas and China. Sales at the Swiss luxury group's jewellery division, which includes brands, of course, like Cartier and Van Cleef, beating analyst expectations, is the latest sign that the luxury industry is emerging from its slump. And we can bring in Bloomberg's Angelina Raskoway for more on all of this. Angelina, just talk us through what stood out in these results for you.
Absolutely. Hi, Lizzie. As you say, Richemont posted double-digit growth rates in all regions in the second quarter. Interestingly, the region that includes China returned to growth. So that's a country that has been suffering for the past almost 3 years amid a downturn because of a property crisis, because of youth unemployment. Chairman Johan Rupert, in the call this morning, he said it's probably too early to talk about green shoots, about a recovery, but still that's very interesting. The strength, obviously, of Richemont is its jewelry maisons, as they call it. That's Cartier and Van Cleef. You know, gold in these uncertain times, hard luxury, as the sector calls it, is seen as a store of value. It's seen as extremely resilient, and probably much more than, you know, handbags or ready to wear. For instance, where LVMH is one of its big rivals, is much more exposed to. So, year to date, the shares now are up 30%. Just today, the market cap went back above 100 billion, close to the March record. So really stellar results. And even the specialist watchmakers returned to growth. That's a division that had been struggling a lot.
Angelina, to the geopolitics, a Trump official yesterday cast the trade talks with Switzerland as positive. What did the Richemont CEO have to say about tariffs?
Today he said that he thinks there's going to be a sort of a clarification when it comes to the tariffs. Switzerland, again, it was hit with a 39% duty from the US in August. That was the highest levy on a developed country. And so there are signs, a bunch of Swiss executives and billionaires like Johann Rupert went to the Oval Office last week. Basically, they're trying to make a deal with President Trump. He loves making deals. And it sounds like we're on the right track for Switzerland to get probably a 15% duty on a par with European peers. But what's very interesting is that the Americas in the second quarter actually was the strongest geography for Richemont. Growth there was 20%. So it shows you that, they applied some price increases, but it shows you that Richemont still has pricing power. And Rupert is, he reminds us of this on a regular basis, because peers in the rest of the industry really, when they really carried out heavy price increases following the pandemic, and Richemont has been more reasonable. So now they're still left with a little bit of margin of maneuver.
So, Angelina, can we conclude that luxury is back? We've already had earnings from LVMH and Burberry. Now we can add Richemont on the top.
I mean, what we saw in this earnings season is that tentative improvement in China. However, all the executives were very careful to say, let's not get ahead of ourselves because it's early days. Earlier this week, our colleagues in China wrote a massive piece about the deflationary environment in China. So we have to see if this is a one-off or if this continues in the coming quarters. Q4 LVMH, for instance, for the last quarter of this year, LVMH warned last month that the comparables will be tough. For Richemont, I think it'll be, the Christmas shopping season is crucial. They launched a new, at Cartier, they launched a new bracelet. The campaign has been out already, and we'll see. But when you create new products, typically this is very good, because you can bring in old and new customers, returning and new customers.
OK, Bloomberg's Angelina Rascoway, we thank you so much. As we look at luxury as part of consumer products and services, of course, one of the only two sectors across Europe this morning managing to eke out gains, that alongside energy. Well, the Citi chair and CEO Jane Fraser says that she's keeping an eye on the US labour market as well as private credit. But she adds she isn't worried right now. Let's take a listen.
I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labour market. It could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26. The challenge for the Fed right now is with the government shutdown. We all have a dearth of up-to-date data, which we could do with. It's hard to make these calls of exactly what's going on whilst we're waiting for the information. But as we look further out into next year, I think the resiliency of the corporate balance sheets, the strength, companies leaning in to innovation, investing in AI. There is, I think the doomsdayers will be proven wrong.
We're a couple months out now from when we had concerns rise about, I think there was one at Tricolor, the subprime auto lender. There were failures. There was concerns about non-performing loans. What does your balance sheet look like as far as that, and where is your worries lie?
Our balance sheet is pristine, but I think part of that is because it's very heavily investment grade on the corporate side. We're over 80% investment grade globally, and when we look at the consumer side, it's about 86% prime. So we tend to see the most resilient, healthiest parts of the economy on the balance sheet. All of that said, we haven't seen a thing that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labour market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
That was Jane Fraser, CEO and chair of Citi, speaking to Bloomberg's Stephen Engel. Well, let's focus on Europe's banking scene now. Jackie Ineke, Chief Investment Officer at Spring Investments, joins me. Jackie, we've heard Jane there. She says she's not so worried about cockroaches in credit just yet. Should we be worried here in Europe?
Absolutely not. I don't think so at all. I think the European banks' balance sheets are extremely strong. I think where you're starting to see these cockroaches, as we call them, or alarm bells, as Andrew Bailey has talked about,
much more,
is in the US.
Nicer term.
Yeah, it's a nicer term, very British. Is very much in the US. And actually, I'm quite surprised that we haven't had more of these alarm bells ringing. There certainly will be more to come, but as long as it stays at this kind of level, one or two every few months, then that's absolutely manageable. And no, I'm not concerned.
Well, where do you think more are to come? Because we've had the Tricolour and First Bank episodes. Where else are we going to expect more alarm bells?
Yeah, honestly, I've absolutely no idea. I really don't know. I mean, but I think it's going to be quite granular. That's the thing, and you'll see them popping up all over in the US, like you should.
Yeah, I suppose the bigger question is how you see regulators dealing with it, because surely they don't want to trigger fire sales by making banks hold more capital.
Yeah, and I think when you're looking at these...
private credit firms.
Exactly, yeah. So it really is the private credit firms that have almost taken the banks out of this sector to the smaller, let's say, medium-sized companies. Now, I think, was it Barclays and HSBC earlier this week talking at the House of Lords Financial Services Committee about it's not fair, there's no level playing field here. The banks, it costs them 5 times more to lend to a small company than it does to lend to a private credit firm lending to that small company. And I get that. Banks are heavily regulated. Private credit firms are not. Now, to answer your question, should we start regulating private credit firms? Will that help? I don't think so. First of all, you need politicians to want to do that. Then you need agreement. And you don't need agreement in Europe. You need it globally. Certainly you need it in the US.
Yeah.
And if you're going to start regulating them in Europe, you're handing the business even more to the US than it is now. So I just don't think there's any incentive to do that. I think a better way forward would be more on the information front, getting more information on what is in these private credit firms.
Well, because there's specifically the concern about insurance regulators and whether they're competent to oversee the risk involved in private credit. That's something that Com Kelleher at UBS has flagged.
Yeah, you can try and regulate this sector. Are they competent? Well, they need some regulations to start with. You need politicians to agree regulations. And ultimately, like you said earlier, we're kind of afraid that if you start regulating these companies, number one, are you cutting off a source of cheapish credit to the companies that need it? And secondly, would you trigger some fire sales at these private credit firms? So there's all these difficult consequences of regulations in this sector, even if the politicians wanted to put them in. And I don't think they do, certainly not in the US.
The other big line out of the UBS chairman was that Switzerland's having an identity crisis. This, of course, his comments on the Swiss government's proposals on new capital rules. Do you agree with him?
Yeah, I'm not sure I would call it identity crisis, but I do agree that, asking them to take another 26 billion of equity, it's too much. For me, I'm a credit analyst. I'd love UBS to have a load more capital, but it makes them anti-competitive. It's just, it doesn't make sense from that perspective.
Well, yeah, if UBS does move its HQ out of Switzerland, what does that mean for investors? What does it mean for the broader Swiss banking system?
Well, if you're assuming that they do, and I don't think they will, I think we'll get to a nice negotiation. And I'm Swiss, so I'll probably vote in a referendum on that in a couple of years, and I don't think I want them to hold a lot more capital. But if they do go out of the country, what will it mean for Switzerland? Well, the Swiss banking operations will still be in Switzerland, but you're taking the HQ out, you're taking a substantial load of staff and operations out. It's not good for the Swiss economy, certainly not for tax revenues as well. So for staff, tax, it's not good. And they better be sure that wherever they go, that regulator is going to say, we're not going to put any more capital charges in there.
Yeah, well, look, Jackie, I know you don't think it's likely, but play it out with me. Where would the HQ move to potentially?
Right, so what you need, you've got a huge global wealth manager. You need to go to a country that has a very high credit rating. You know, so you have that comfort behind it. So it kind of rules out quite a few countries in Europe. But you could go to the US, you could go to Asia. These are where UBS has a huge amount of operations already, so there'll be a cultural fit. But, you know, high credit rating. Secondly, you have to have a regulator that says, we want an enormous GSIB. We want them to be here that we're in charge of and we can regulate. So, I don't know, maybe that makes it Singapore, maybe it makes it the US. Again, I don't think they'll go, but you would have to have those kind of characteristics.
Just finally, we had the news this week that ABN AMRO is going to buy NIBC from Blackstone. You've written this week that there's a number of sleeping giants in Europe, like ABN. Who do you mean?
Yeah, well, you won't ever see these in the equity reports because there are other banks like Belfius in Belgium. You know, you probably won't have heard of that, but it's government-owned. It failed in the crisis. Like ABN was government-owned and is just coming out of government ownership. Yeah. And that's why I think, you know, you can see, you know, all bets are off in terms of where they're going to go now, who they're going to buy. It's the same for someone like Belfius. They're about to start getting privatised. New CEO coming in, new strategy. You know, at Spring we own a lot of these acquisition targets. And I think you get into this perfect storm with European banks. They're overcapitalised. Regulations are pretty much at an end. We're, in fact, going the other way. So you know your share count. Share prices have done better than the Nasdaq over the last few years for the European banks. So you've got some currency to buy. And the ECB wants consolidation to happen. Some national governments don't, and that's a different story. But you've got all these things together, and overcapitalised banks, they can go and they can buy smaller banks, they can get more fee income. It makes a huge amount of sense, and that's how we're playing it, by owning the smaller banks, the acquisition targets.
Well, the Greek finance minister was certainly in support when I spoke to him earlier. Jackie, always good to have you on. Jackie Ineke, Chief Investment Officer at Spring Investments. Thank you. Well, Wall Street has been shaken in recent weeks by the collapse of an auto parts supplier that filed for bankruptcy with more than $10 billion in debt, as we were just discussing. Franklin Templeton CEO Jenny Johnson has been speaking to Bloomberg's Francine Lacqua about how she manages the risk in credit markets.
Any credit can be very risky or not. Silicon Valley Bank showed that the U.S. Treasuries were risky because duration is an important component of risk in fixed income. And so that's what I mean by thinking about risk as you and how you align that risk with whatever those clients' needs are. So as you look to democratize access to private markets, we have to be really cognizant. And I always say that it's the most important thing is the tip of the spear. We're big believers in the financial advisor being the person who's making that decision along with their client. People ask me, because we've done 10 acquisitions since I've become CEO, and they say, well, how do you make sure that the culture fits? And so I often say, well, if you're evaluating a company, clients first. My dad always says, take care of the client, and the business takes care of itself. The second is, do they show that they're collaborative amongst each other, right? Do they seem to get along? Are they open and willing? Because what can go wrong in an acquisition is that there's an attitude of, we're separate, we're not going to participate. So you need people who will collaborate.
And you can watch that full interview with the CEO of Franklin Templeton, Jenny Johnson, on Leaders with Francine Lacqua. That's at 5:30 p.m. in the UK today, or 7 p.m. Eastern Time stateside, or stream it tonight at 8 p.m. Eastern Time on the Bloomberg Originals stream. This is Bloomberg. For more than 4 decades, Richard Moore worked in total secrecy as a career officer inside Britain's MI6. His identity became public only when he was appointed chief in 2020. And in his first interview since stepping down in September, he spoke to Bloomberg's Michal Hussain. They discussed China, Putin's mindset, and the realities of a job that isn't built for recognition.
Our voice is one that is listened to in Washington. So things change, move around a bit. That's the style of the current administration. But we are always there, and it's our responsibility to use that to convey exactly what the intelligence is telling us. And it's telling us, for example, that Putin has no intention of doing a deal, that this is not an issue for him purely of territory. This is about dominating Ukraine and turning Ukraine into something that looks rather like its neighbor, Belarus. So all of that stuff we talk to the Americans about all the time.
So
and I think you can see sometimes the impact of
doing
that.
A deal, Vladimir Putin, if he has no intention of doing a deal, then how do you see this ending this
at the moment? So I don't think under current conditions that Putin. Well, I mean, I'm basing this on access as I had a few weeks ago to our understanding of the intelligence on it, and that is that he's not ready to do a deal. So for me, the answer to that is he needs to be put under more pressure. So he is prepared to do a deal. The president of Ukraine is clearly ready to do a deal. He's remarkably, in the pursuit of peace, prepared to give away up to 20% of his country. De facto, and yet Putin is not. So what's going to change that? More pressure on the battlefield. Ukrainians have an undercapitalized defense industry. They have spare capacity that cash would solve. There is more that we can give them. There is more that we can give them in terms of permission to use long-range weaponry, for example. There's all of that, as well as giving them the sort of, the basics of air defense and all that. And there's an opportunity to put a lot more pressure on Putin at home. And I don't pretend that is going to give immediate results. One of the things I would say in this space is we have to be patient. We have to be prepared to see this off.
And you can listen to that full conversation between Michelle Hussein and the real-life Richard Moore by searching The Michelle Hussein Show wherever you get your podcasts. Now, the Ukrainian capital has come under attack by Russian drones and missiles. The mayor of Kyiv has described it as a massive enemy attack and says at least 25 people have been wounded. Meanwhile, Ukraine has carried out a major drone attack, causing damage to a Russian oil depot in the Black Sea. That news sending oil higher this morning. Elsewhere, German lawmakers have approved several big-ticket military procurement deals worth €3.9 billion as part of Chancellor Friedrich Merz's plans to massively ramp up the country's armed forces. The list of defence contracts include 20 light combat helicopters from Airbus. They also cover 100,000 night vision devices from Hensoldt and Theon under a contract worth roughly €1 billion. And the BBC has issued a formal apology to US President Donald Trump for a misleading edit of his January 6th speech. But the corporation has rejected his billion-dollar compensation demand, saying there is no basis for a defamation claim. It follows accusations from Trump's lawyers that the clip was deliberately altered to influence the US presidential election. Well, those are some of your top stories from around the world this morning. I want to stay in the UK because it's certainly been a rocky end to the week for UK markets. Speculation about the budget highlighting the uncertainty over the nation's fiscal position. Kit Rees, our co-editor of Bloomberg's Markets Today blog, joins me now for analysis. Kit, these moves pretty serious, but we have to put them in historical context. I'm thinking about when the Chancellor cried. Of course, I'm thinking about the ultimate benchmark, Liz Truss, the Liz Truss moment. How bad were they and how much have we paired?
So we're definitely seeing a bout of volatility for UK assets. So we had the report in the early hours that the Chancellor is planning not to increase the income taxes, and this has really pressured the pound. Gilt yields also spiked at the open. So they've been pretty dramatic moves, but we're not quite there yet in terms of something like a Liz Truss moment. And it kind of signifies the volatility to come in the weeks ahead of the budget. We've also had a report since then that it was actually improved OBR forecasts that were behind the Chancellor's plans to drop the income tax hikes. So overall, lots of reports, there's lots going on. It looks like we're going to have to kind of strap in for a rocky ride over the next few weeks. But the moves, even though they've paired, they're still notable, they're still standing out in the European context. But all it shows is there's a lot of uncertainty, lots of worries over fiscal headroom, what measures we can expect, and the volatility is likely to persist.
Yeah, the idea that it comes down to a forecast doesn't seem to have quite soothed the 10-year yield. We're still up 7 basis points at the long end. I also want to talk about the moves in Bitcoin because they've been pretty substantial. We're now at $96,840 a token, down nearly 2%. Is that a harbinger of the end of the AI bubble? What's going on here?
So I think it's more a characteristic of showing what Bitcoin is really. So it's over the summer, it got this sort of characteristic as a bit of a safe haven asset alongside things like gold. But actually, it is quite volatile. It is a cryptocurrency at the end of the day. So it's down about 20% from a June peak. And, perhaps this is a little bit of a healthy correction given the big rally, the record highs. But in terms of whether it's a harbinger of the AI bubble, that's a huge debate in markets right now. So tech stocks have, lofty valuations, but the argument I hear often is that it's underpinned by earnings growth, by big spending. But in terms of a little bit of a pullback, it is possible in order to keep things in check, and it wouldn't be completely surprising at this point.
All right, Kit, love the blog. Thanks for joining us. Kit Rees, co-editor of Bloomberg's Markets Today. Hope you have a good weekend. You were looking at NASDAQ futures down 0.6%, S&P E-mini futures down 0.3%. That does it for the Pulse. We pass the baton to New York. Bloomberg Brief coming up next with Bonnie Quinn. This is Bloomberg.